how to build a simple portfolio that beats 90% of professional investors. So step one is building a simple portfolio. Instead of trying to pick winning stocks, which is hard for even professionals, I've discovered a simple 3 ETF portfolio that consistently outperforms. I call it the 70-20-10 portfolio. And it's the exact same approach used by the top 1% of investors. So for Canadians, put 70% in VFV, the Vanguard S&P 500 Index ETF. It trades on the Toronto Stock Exchange with a 0.08% management fee. For Americans, put that 70% in VOO, the Vanguard S&P 500 ETF that trades on the New York Stock Exchange with 0.03% management fee. Both give you a piece of the 500 largest US companies with returns of about 10% per year. And let me explain what these management fees or expense ratios actually mean for your money. If you invest $1,000 in VFV with its 0.08% fee, you'll pay just 80 cents per year. With VOO's 0.03% fee, you pay only 30 cents per year. Compare that to a typical financial advisor who might charge you 2%. That would cost you $20 per year for the same $1,000 investment. The difference seems small at first, but look what happens over time. If your investments grow to $1 million after 30 years, you'd pay $800 per year with VFV, $300 with VOO, but a whopping $20,000 per year with a 2% advisor fee. Over those 30 years, you would have paid an extra $312,000 in fees with the advisor compared to these low-cost ETF. That's money that could have stayed in your pocket and kept growing for you if you just used the simple ETF approach. And now that we understand why these low fees are so powerful, let's continue building our portfolio. While the S&P 500 gives us great exposure to large American companies, we want to further diversify our remaining 30%. So for Canadians, 20% in XIC, the iShare Core S&P TSX Cap Composite Index ETF. It has an even lower 0.06% fee and covers the main Canadian stock market. For Americans, put 20% in VEA, the Vanguard Developed Markets ETF. It's a low 0.05% fee and covers developed international markets outside the US, so Canada and Europe. This reduces currency risk since you're investing in your home country's companies. This is for Canadians because you're trading in your local currency. You get exposure to strong domestic businesses without trying to guess which specific companies will do best. Now for that last 10%, for Canadians, put 10% in XCC, the iShares Emerging Markets ETF with a 0.26% fee. For Americans, put that 10% in VWO, the Vanguard Emerging Markets ETF with a 0.08% fee. Both give you exposure to fast-growing countries like China, India, and Brazil, offering higher growth potential, but with more ups and downs. This mix gives you ownership in thousands of companies worldwide while focusing on the historically strong US market with enough exposure to domestic and emerging markets for balance. Think of it like planting a garden. You're putting the most seeds in soil that has proven to grow well, the US, some in your local soil you know well, your home country, so Canadians, and a few seeds in areas that might grow extra big but are less certain, emerging markets. If that still sounds too complicated, there's an even simpler approach for complete beginners. For Canadians, consider a single all-in-one ETF like VEQT, the Vanguard All Equity ETF, or XEQT, the iShare Core Equity ETF portfolio. For Americans, consider a single all-in-one ETF like VT, the Vanguard Total World Stock ETF. One purchase gives you thousands of global stocks at a low fee with zero work required. It's like buying a pre-made meal kit instead of shopping for and preparing all those ingredients separately. Also, you'll have noticed that I mentioned Vanguard a lot. They're not sponsoring me, and you don't need to buy these particular ETFs. You could use BlackRock or any other companies. They all have the exact same type of ETFs with similar low fees. My choosing Vanguard has more to do with personal preference rather than which will actually perform better. So just pick whatever. But in the end, this portfolio approach is similar to what Warren Buffett recommends. Put 10% of the cash in short-term government bonds and 90% in very low-cost S&P 500 index fund. He understood the importance of keeping it simple. And quickly, I've noticed that over 80% of viewers who watch this channel aren't subscribed. If you find this video helpful, hitting the subscribe button is an easy way to support the channel and help me create more videos like this. And I promise to keep making truly helpful content for you and everyone else watching. Now, you might think once you've set up this simple portfolio, you're all set to watch your money grow. This is exactly where most investors make 5 deadly mistakes that can cost them hundreds of thousands in retirement savings. So let me show you how to avoid them. So step 2, avoid common investor mistakes. From my own experience and observations, I noticed that many investors struggle with these 5 common mistakes that can destroy their returns. So mistake number 1 is trying to time the market. Even experts on TV can't consistently predict market movements. Regular, consistent investing, regardless of market conditions, often works better. Investors who stayed fully invested through market ups and downs did almost 50% better over 20 years than those who missed just the top 10 best days. Trying to time the market is like trying to predict exactly when it'll rain. Even weather experts with all their tools get it wrong on a regular basis. Mistake number 2 is checking investments daily. This can lead to emotional decisions that hurt your returns. Checking every 3 months is often enough. Investors who check their portfolios daily trade 70% more often and earn 4% less per year. The difference adds up to hundreds of thousands of dollars over a lifetime. It's like watching a pot of water boil. Checking it constantly does not make it boil any faster. It just makes you anxious. And mistake number 3 is panic selling during downturns. Market drops are normal and temporary. They can provide chances to buy companies at lower prices, and the S&P 500 has had an average yearly drop of 14%, but still has positive returns in 32 of the last 42 years. Think of market drops like a sale of your favorite store. Smart shoppers get excited about buying things they wanted anyways at a discount. Mistake number 4 is chasing last year's top performers. The best performing sector rarely repeats the following year. Funds receiving the most new investment dollars are typically those that did the best in the previous year, yet they often do worse the following year. It's like driving while only looking in a rear view mirror. You're focused on where you've been, but not where you're going. And mistake number 5 is making things too complicated. A straightforward ETF approach has served many investors well over the long term. The more complex your strategy, the more likely you are to make mistakes or give up during tough times. Think of investing like cooking. You don't need fancy ingredients or complex recipes to make a satisfying, nutritious meal. All right, now that you know the portfolio to build and the mistakes to avoid, let's back up and look at the foundation you need to start investing a single dollar. So step 3, build your money foundation. Before you put a single dollar into the market, you need 3 important money basics in place. So foundation number 1 is your emergency fund. Save 3 to 6 months of expenses in a high interest savings account. For most families, that's about $15,000 to $20,000. Keep this money completely separate from your investments. Most people skip this step and they end up selling investments at the worst time when an emergency happens. I've seen this mistake cost thousands in lost growth. Foundation number 2 is paying off high interest debt. If you have credit card debt or loans with interest rates above 8%, pay those off first before investing. The average credit card debt comes with interest rates of 19 to 22%. This means that you're losing hundreds of dollars every year just on interest. It's like trying to fill a bucket with water while there's a big hole in the bottom. Foundation number 3 is getting free money. If your job offers retirement account matching, put in enough to get the full match. That's an instant 100% return on your money, something you won't find anywhere else. And many people don't claim this free money, leaving billions unused each year. And for young people in their 20s and early 30s, getting these basics in place puts you ahead of nearly 70% of others your age. Government reports show that 35% of young adults have no savings at all, while another 25% have less than $5,000 saved. Now that your foundation is solid, the next critical step is choosing the right account type. And this decision alone could mean hundreds of thousands of dollars difference by retirement. So step 4, choose the right account type. We have 2 main tax advantage accounts that can really boost your investment returns. And I'm going to try to speed through this for you guys. For Canadians, it's a TFSA, the tax-free savings account, and RRSP, registered retirement savings plan. For Americans, it's a Roth IRA and traditional IRA 401k. For Canadians, the TFSA gives you $7,000 in room for 2025, plus any unused room for the past years. All that growth and withdrawals are completely tax-free. You can take out the money anytime without penalties, and you get your room back the next year. For Americans, the Roth IRA allows contributions up to $7,000 in 2025 or $8,000 if you're 50 and above. All growth and qualified withdrawals are tax-free. You can withdraw your contributions, but not your earnings anytime without penalties. Think of these accounts like a special garden where you never have to share any of the fruits you grow with a tax collector. Everything you grow is 100% yours to keep. Now, For Canadians, the RRSP lets you put in 18% of last year's income up to $31,560 for 2025. Putting money in reduces your taxes now, giving you an immediate tax break. You'll pay taxes when you take your money out in retirement. For Americans, the traditional IRA or 401k and 401k allow pre-tax contributions that reduce your current taxable income. The 401k limit is $23,000 in 2025 plus $7,500 catch-up if you're 50 and above, while the traditional IRA limit is $7,000 or an $8,000 if you're 50 and above. You'll pay taxes when you withdraw in retirement. Taking money out early comes with tax penalties, except for specific exemptions like buying your first home. So which should you use first? For most beginners, especially those starting their careers or with lower incomes, starting with a TFSA for Canadians or Roth IRA for Americans makes the most sense because they're more flexible. Consider using a RRSP or traditional IRA 401k after filling your tax-free account, especially if you're in a higher tax bracket. This small decision can mean hundreds of thousands of dollars difference in your wealth over time. Using the wrong account for your situation can cost you tens of thousands of dollars in extra taxes. So now you know the right account to use, but you might be wondering, how do I actually open one and start investing? Well, let me show you how simple this really is. So step 5, open a brokerage account. To start investing, you'll need to open an account with a brokerage. You can set this up online through your bank or through a trading app. I've included a link to a sponsored trading app in the description and first pinned comment to help you get started. But the key isn't which brokerage or trading app you choose. They all offer similar main services. What matters is that you actually open the account. This is where many people get stuck in the research mode forever and never take action. It's like planning a road trip, but never actually getting in the car and driving. So pick one, open the account, move forward. Once you set up your account, you'll need to make your first purchase. And this is where most beginners freeze, but I'll show you exactly how to do it without stress. So step 6, make your first purchase. Once your brokerage account has money in it, making your first ETF purchase is easy. Log into your brokerage account, search the ETF symbol like VFV or VOO, select buy, choose market order to keep it simple, enter the amount you want, confirm your order. And a lot of people get nervous at this step, worrying that they're making a big mistake. Remember, you're buying an ETF. That represents hundreds or thousands of companies, not a single stock that could go to zero. This spread out approach makes your first purchase far less riskier than you might think. It's like learning to swim in the shallow end with a life jacket on instead of diving into the deep end of the pool. Now, making one purchase is great, but the real secret to building wealth isn't making a single good investment. It's what you do consistently over time. So step 7 is set up a consistent investment plan. The most important thing in investing isn't timing the market or picking the hottest stocks, it's being consistent. Set up automatic investments timed with your paycheck to build wealth steadily over time. Consider these numbers. Just $100 per month at 10% average return grows to $19,000 after 10 years, $72,000 after 20 years, $228,000 after 30 years, and $637,000 after 40 years. And this is even more powerful inside a tax advantage account where all that growth is tax-free or tax-deferred. Studies show that investors who start in their 20s end up with nearly 3 times more wealth at retirement than those who start in their 40s, even if the later starters contribute twice as much monthly. It's like planting a tree. The earlier you plant it, the bigger it will grow, and no amount of extra water and fertilizer can make up for those early years of growth. Time in the market always beats trying to time the market every single time. But if you're an older investor and you haven't started yet, start now. And to see exactly how the 7-step system could grow your wealth over time, check out my free investment profit calculator in the description. It'll show you the power of consistent investing using the strategy we've outlined today. Now let's go over some frequently asked questions. How much money do you need to start? Well, you can begin with as little as the price of one ETF share. That's typically between $20 to $200 depending on the fund. Many brokerages now offer fractional shares, allowing you to start with even less. But what matters most isn't about how much you start with, but that you start at all. Even $25 per week is enough to begin building wealth. All right, how long should you invest for? At a minimum, don't invest money you'll need within the next 2 years. Ideally, think in terms of 5 or more years, with retirement money staying invested for decades. If you buy VFV or VOO, that's retirement investments, 10 or more years. Historical data shows that S&P 500 has never had a negative return over any 20-year period, despite including the Great Depression, World War II, the 2008 financial crisis, and every other major economic challenge. All right, what about dividends? all the ETFs I've recommended do pay dividends, but they really focus on total return, so growth plus dividends rather than just dividend investing, because if you're looking for capital gains and long-term investing, dividends don't make sense, especially for beginners. So should you buy individual stocks? Well, consider mastering the basics with ETFs and building substantial savings first. Even then, keeping individual stocks to no more than 10 to 30% of your total portfolio can help you manage your risk. It's like learning to drive in an empty parking lot before heading into the highway. Should you only invest in your home country? While it is tempting to focus exclusively on familiar companies, data shows that global diversification has consistently provided better results than a single country approach. It's like eating a varied diet instead of eating just one type of food. You get more nutrients and protection if one food group becomes contaminated. Many people delay investing because they're waiting for the perfect time to start, but here's what I've learned. The best time to start was years ago. The second best time to start is today. All right, check out these two videos for more investing tips. Bye guys.